Silver has just entered a moment that could prove far more important than a simple price surge, because beneath the headline number, something much larger is developing. A powerful shift in liquidity, government debt markets, monetary policy, and investor positioning is beginning to converge. And silver may be revealing the first visible signs of that transition. The most important question is not what silver has already done, but why it is happening now, who is driving the move, and what could happen if this momentum continues. The answer leads directly to a major announcement that could reshape the outlook for precious metals. Welcome to Precious Metals Intelligence, where major developments in gold, silver, monetary policy, and global markets are examined through a strategic economic lens. Viewers are invited to follow the channel and subscribe for future analysis, particularly those seeking a clearer understanding of how financial decisions made in Washington and global markets can affect hard assets and long-term wealth. Viewers are also invited to share where they are watching from, creating a broader picture of how investors around the world are observing this developing situation. Silver has just done something that deserves closer attention than a simple price increase. The metal has moved with unusual strength, and the speed of that move has changed the conversation around the market. For investors who have followed silver for years, the important issue is not simply whether the price can move higher. The bigger question is what is pushing it higher at this particular moment. A strong rally can happen for many reasons, but when silver begins outperforming gold while major financial markets are dealing with pressure, the move can carry a much deeper message. That is where the latest development becomes important. The first signal is silver's sudden change in momentum. After spending time below major resistance levels, silver has pushed into territory that had previously stopped buyers. Once those levels were broken, the market began moving with greater speed. This matters because price levels are not just numbers. They represent areas where large groups of investors have previously decided to buy, sell, or wait. When a major resistance level is broken with strong momentum, traders often begin reassessing their expectations. Some investors who were waiting for a pullback may enter the market, while others who were positioned against the rally may be forced to reconsider those positions. But the most unusual part of the move is silver's performance compared with gold. Gold remains one of the world's most important monetary assets, and it often attracts capital when investors become concerned about currencies, inflation, debt, or financial stability. Silver can benefit from those same forces, but it has another important characteristic. It is also an industrial metal that gives silver two separate sources of potential demand. When monetary concerns increase while industrial demand remains firm, silver can receive support from both directions at the same time. Because the silver market is much smaller than the gold market, even a relatively modest shift in investment capital can create a much larger price reaction. That difference may explain why silver can suddenly appear to move faster than the broader precious metals market. The market does not need a dramatic increase in total capital for silver to experience a dramatic price change. A change in expectations can be enough. Once investors begin believing that silver has entered a new trend, momentum can attract additional buyers. This creates a cycle in which rising prices change expectations, and changing expectations create additional demand. However, such moves are rarely smooth. Profit-taking can produce sharp pullbacks, and those pullbacks can test whether the underlying demand is actually strong. That leads to the central issue behind this entire development. Silver's latest move may not be important because of the price alone. It may be important because several forces appear to be changing at the same time. Government debt markets are under pressure, monetary policy remains uncertain, inflation concerns have not disappeared, and investors continue searching for assets that can protect purchasing power. Silver sits directly at the intersection of many of these forces. The market is therefore facing a much larger question than whether silver can reach another psychological price level. The real question is whether this move represents the beginning of a broader shift in how capital is positioned. And the answer may depend on a major policy development that is only now becoming clear. The most important part of the silver story may not have happened inside the silver market at all. It may have started inside the U.S. Treasury market. That distinction matters because financial markets are connected in ways that are not always obvious. A decision involving government bonds can eventually influence interest rates, the U.S. dollar, investor behavior, gold, silver, and even the cost of capital for businesses. For that reason, investors who focus only on the silver chart can miss the larger development taking place underneath the surface. The key development has been a shift in how the U.S. Treasury manages long-term debt. Recent signals suggest an increased willingness to conduct bond buybacks, a tool that allows the government to repurchase previously issued securities from the market. While this may appear technical, it can have meaningful implications for liquidity conditions and long-term yields. When the Treasury becomes more active in this part of the market, investors naturally ask why. Long-term government bonds are supposed to represent the deepest and most stable segment of global finance. If policymakers are adjusting their approach, it often reflects concern about how that market is functioning. Rising yields in particular can create pressure across the entire financial system. They increase borrowing costs for households through mortgages, for corporations through credit markets, and for governments through higher interest expenses. They also affect asset valuations more broadly. Since discount rates are a core input in pricing everything from equities to real estate, this is where silver begins to re-enter the picture. Precious metals do not generate yield. They do not pay interest or dividends. Their value is driven instead by supply, demand, and investor perception of monetary stability. When real yields rise, metals can struggle. When real yields fall, or when investors expect future monetary easing, metals often become more attractive. If Treasury actions are interpreted as a sign that policymakers may need to stabilize long-term yields, that interpretation alone can shift sentiment toward gold and silver. The US dollar adds another layer of sensitivity. Because metals are priced in dollars, any change in dollar expectations can influence global demand. A weaker dollar can make silver cheaper for international buyers, while also reinforcing the idea that hard assets may be needed as a hedge against currency uncertainty. Importantly, none of this operates in isolation. Investors are simultaneously weighing inflation trends, Federal Reserve policy, economic growth, and geopolitical risk. The Treasury announcement does not override these forces, but it interacts with them in ways that can amplify market reactions. Timing is what makes the current environment notable. Silver strength has emerged while bond markets are already under close scrutiny. That overlap creates a feedback loop between markets that are usually analyzed separately. What happens in treasuries can influence expectations for liquidity, and those expectations can quickly spill into precious metals. The Federal Reserve remains central to this dynamic. Policymakers face a difficult balancing act between controlling inflation and maintaining financial stability. If rates remain high for longer, financial pressure can build. If conditions tighten too much, liquidity concerns can emerge. Either path can have meaningful consequences for assets like silver. At the same time, silver's industrial demand cannot be ignored. Its use in electronics, solar energy, and electrification means it is tied to real economic activity. This dual identity, monetary asset and industrial commodity, makes silver more sensitive to macro shifts than gold in many environments. Gold is primarily a reserve and monetary hedge. Silver is both a monetary asset and a critical input in modern industry. When financial uncertainty rises, while industrial demand remains stable, silver can benefit from two separate sources of demand at once. That combination can produce outsized price movements, especially in a relatively small market. Compared to gold, silver's market size is much smaller, meaning incremental capital flows can have a larger impact on price. The Treasury announcement, therefore, does not directly explain silver's move. Instead, it changes how investors interpret the broader financial landscape. It raises questions about liquidity, bond market stability, and future policy direction. Markets often respond more to those questions than to the initial event itself. If investors conclude that policymakers are becoming more active in managing long-term yields, they may begin to reassess the role of assets that are less dependent on government debt stability. That reassessment can gradually increase interest in precious metals. The result is a chain reaction. Treasury policy influences bond expectations influence yields influence currency and liquidity conditions, and those conditions ultimately shape demand for gold and silver. Silver's recent strength may therefore be less about a standalone breakout and more about a shifting macro environment beneath the surface. Whether that shift continues will depend on how bond markets behave next, how the Federal Reserve responds, and whether liquidity conditions tighten or ease in the months ahead. If the pressure inside the financial system continues to build, silver's move may be remembered not as an isolated rally, but as an early signal of a broader transition in global markets. There's a point in every major market cycle when investors stop asking whether an asset can rise and start asking why it is rising faster than everything around it. Silver may be approaching that point. The unusual feature of the current move is not simply that silver is gaining ground. It is that silver has shown the ability to accelerate while the broader precious metals market remains divided. Gold can remain strong, while silver moves faster, and that difference can reveal something important about where capital is flowing. For decades, gold has held the stronger position among precious metals. Central banks hold it. Governments recognize it as a reserve asset. Large institutions use it as a hedge against currency and financial risk. When uncertainty increases, gold is usually one of the first assets investors consider. Silver operates differently. It has a monetary history, but it is also deeply connected to the real economy. Silver is used in electronics, electrical systems, solar technology, medical applications, and many other industrial processes. This gives silver a unique position. It can respond to monetary uncertainty like gold, while also responding to industrial demand like a traditional commodity. That combination can become extremely powerful under the right conditions. If investors grow concerned about currencies, debt markets, or financial stability, Capital tends to move toward precious metals. At the same time, if industrial demand remains strong due to continued investment in technology, energy infrastructure, and electrification, silver receives support from two separate engines of demand. Gold benefits mainly from monetary fear. Silver benefits from monetary fear and industrial consumption. That dual exposure is one of the core reasons silver can outperform during certain cycles. There is also a structural factor that amplifies every move: market size. Silver is far smaller than gold in total market value. As a result, incremental capital flows have a disproportionate impact. A large institutional allocation that would barely register in gold can create meaningful price pressure in silver. This is what allows silver to move quickly once momentum begins, and momentum itself becomes a second force. As prices rise, attention increases. Investors who previously ignored silver begin to notice relative strength. Analysts revise forecasts. Technical traders identify breakouts. Short positions are covered. Long-term holders become less willing to sell. Each layer adds incremental demand on top of existing demand. However, this process is not linear. Sharp advances are often followed by equally sharp corrections, especially when positioning becomes crowded. These pullbacks are not necessarily bearish. They can reset sentiment and create healthier conditions for continuation. Another key indicator is the gold to silver ratio. When the ratio is elevated, silver is historically considered cheap relative to gold. When it declines, silver is gaining relative strength. While not a precise valuation tool, it is widely watched because it reflects shifting capital preference between the two metals. A sustained decline in the ratio would suggest that silver is attracting increasing attention compared to gold. The deeper question is why that shift might be happening now. Part of the answer lies in how investors are reassessing traditional safe assets. For years, bonds and cash were considered reliable defensive tools. But rising debt levels, persistent inflation concerns, and volatile interest rate expectations have complicated that assumption. A Treasury bond may carry minimal default risk, but it still carries inflation risk, duration risk, and currency risk. If inflation remains elevated, real returns can be eroded. If yields rise, bond prices fall. Silver, by contrast, carries no yield and no repayment promise. It exists outside the credit system entirely. That independence becomes more valuable when confidence in financial structures weakens. Still, silver is not a pure safe haven. Its industrial demand makes it sensitive to economic slowdowns. Its price is influenced by the dollar, interest rates, and global growth conditions. This creates a mixed environment of opportunity and vulnerability. The Federal Reserve remains central to the outcome. If inflation proves persistent, policy may stay restrictive longer, supporting higher real yields and pressuring metals. If growth weakens, policy may shift toward easing, increasing liquidity, and supporting precious assets. In that second scenario, silver also benefits from trend-following behavior. Once a strong uptrend is established, investors often buy dips rather than sell strength, reinforcing momentum. The key question is sustainability. Can silver hold gains after the initial surge? Can demand persist beyond speculative interest? Can macro conditions remain supportive long enough for a structural trend to develop? If the answer is yes, the implications extend far beyond a simple commodity rally. Because in that case, silver is not just reacting to market noise. It is responding to a deeper shift in liquidity, confidence, and capital allocation, and that is where the real warning begins to emerge. The silver rally now reaches its most important stage, because the biggest risk may not be missing the next move higher. The bigger risk may be misunderstanding what the move is actually signaling. Silver has demonstrated unusual strength, but the market still faces competing forces. Treasury policy may support liquidity, while Federal Reserve policy could remain restrictive. Inflation could keep pressure on interest rates, while concerns about government debt could increase demand for hard assets. Industrial demand could remain strong, yet a weaker global economy could eventually reduce commodity consumption. This is why the next phase cannot be judged by one price target alone. The critical signal will be whether silver can hold the gains already achieved. If higher prices are followed by stable support rather than a deep reversal, investors may view the move as evidence of stronger underlying demand. If silver quickly loses important support levels, however, the market could conclude that speculation moved faster than fundamentals. The same principle applies to gold. If both metals continue rising together, it would suggest that the broader monetary argument is strengthening. If silver continues outperforming gold, it could indicate that investors are becoming increasingly aggressive in their precious metals positioning. But there is another possibility. The Federal Reserve could maintain restrictive policy for longer than markets expect. Higher real yields could strengthen the dollar and reduce the appeal of non-yielding assets. In that environment, silver could experience a sharp correction even if the long-term fundamentals remain constructive. That possibility should not be ignored. A disciplined investor does not assume that every breakout will continue. Instead, the investor watches the forces behind the breakout. Treasury activity, bond yields, dollar strength, inflation expectations. Industrial demand and Federal Reserve policy will all matter. Together, they will determine whether silver's recent strength develops into a lasting trend. The major announcement, therefore, deserves attention for a reason that goes beyond silver itself. It highlights the growing importance of liquidity and debt market stability in determining where capital moves next. If government debt markets require increasing support, investors may begin asking whether traditional financial assets still provide the same protection they once did. That question could push more capital toward hard assets over time. Silver would be positioned directly within that transition. Its relatively small market, industrial importance, and monetary characteristics create the possibility of significant upside when demand accelerates. But those same characteristics also make silver volatile. Large gains can be followed by large declines, sometimes without warning. That is why the most important development may not be whether silver reaches a specific number next. The real question is whether the forces behind this rally continue to strengthen. If liquidity expands, bond market concerns persist, the dollar weakens, and industrial demand remains healthy, silver could have a powerful combination of support. If those conditions reverse, the metal could face significant pressure. Either way, the message from the current market is difficult to ignore. Silver is no longer moving in isolation. Its behavior is becoming increasingly connected to decisions involving government debt, monetary policy, inflation, industrial demand, and global capital allocation. For serious investors, that connection may be more important than the headline price. The next major move could therefore tell the market whether this was simply another silver rally or an early warning that the financial environment itself is changing. Viewers who have followed the analysis this far are encouraged to subscribe to Precious Metals Intelligence for future coverage of these developments. They are also invited to share where they are watching from, because the consequences of changes in global financial markets extend far beyond one country or one asset. The silver market has already delivered its warning. Now the question is whether the market is ready for what comes next.